While we're waiting for people to come in, though, let me just give you a quick update on what's happening with the markets, because, you know, after inflation made its drop last week, after core inflation made its drop, again, not very big drops, but they did drop. You know, and after the fact that it's 10 now consecutive months of dropping, one would think that, hey, you know, we've been saying for months May 10th is going to be a great day and everything's going to drop. Well, there's been some other things that have kind of created a little bit of a mess. One of those being the debt ceiling. And I'm sure you may have heard it online or watched it on TV. You know, Congress and the president are trying to come together on raising the debt ceiling, which just comes up every once in a while. And, you know, and they will arrive at a resolution, but while it is still up in the air. Now, there's a meeting tomorrow with congressional leaders and the president to hopefully arrive at a resolution. But as a result of the fact that it's not resolved yet, what's happening with the 10-year yield, the 10-year bond, the 10-year bond has been going up ever since Thursday. So it just keeps blipping up a little bit. And today it actually went up over 3.5 and we were down as low as 3.3. So with that in mind, you know, rates have not made the drop that we had kind of hoped and thought for. Now, if they arrive at a resolution, hopefully sooner than later, you know, we'll probably see things ease up again. And then the big thing will be what happens in June and what happens in July. Because when they announce July, which will be June's numbers, that's going to be pretty significant, because that, if you recall, June of last year was the highest inflation rate we've had in, oh my gosh, decades. So that spread is going to be a big deal. So we'll see what happens. There's all kinds of other factors that come into play, but the bottom line is inflation continues to come down. The Fed may or may not raise their Fed rate in June. There's talk going both ways about it. Personally, I could care less if they raise it or leave it, because if they raise it, they're just trying to curb inflation, which is driving our rates down. And we're still going to see a very positive impact by the end of the year, certainly into the beginning of next year. So again, today, Thursday, Friday, today, maybe even tomorrow, a little bit tentative until Congress and the government and the president arrive at some kind of a conclusion on the debt ceiling. So, but what I want to talk about today is was inspired by Beautiful Jay, because I thought about it and I thought, okay, let's try to figure out. Everybody in the room has probably had, if you've done any real estate transactions at all, at some point in time you probably had a head scratcher that said, why did this happen this late in the process with the loan? Have you ever had that happen? You know, you're just wondering, why did that happen this late in the loan? All right, so I'm going to talk about two things. I'm going to talk about mistakes that the lender makes, and then I'm going to talk about things that happen that just happen. And let's see if we can decipher those. So at the very beginning, pretty much everybody in the room, I'm confident, is just knowing most of you, you go out and you have your borrower make sure that they get pre-approved. We've discussed the difference between pre-qualification and pre-approval before. You want them pre-approved. Now, not every lender's pre-approval is the same thing. You already know that, because they may not review documents. That's what we're going to talk about now. But at the very beginning, before they ever have a contract, you want them to be pre-approved. Now, the process for a pre-approval, in my opinion, with 33 years in this crazy business, says that once the borrower completes the application, they have to send us all their documents. Now, when I say all their documents, the most important documents are income documents, first of all. Pay stubs, W-2s if they're a W-2 employee. If they're self-employed, heavily on commission and bonuses, we may have to look at tax returns. Certainly if they're self-employed, we've got to look at tax returns. And we have to do that calculation. That is not something that happens online. Now, Then, once you have that in and you pull a credit report, oh, by the way, credit reports. Make sure your lender is running a legitimate credit report and not some. Now, there are soft pulls that you can do today, and Freddie Mac will accept the soft pull. I get all that, but be sure that you're getting a full report that is going to be used in underwriting. That's critical. So, let's say you get the full report. Now, some lenders, and there's a lot of them that do this, all they do is send you your pre-approval. That's it. They don't call the borrower. They may not even speak to the borrower. The borrower does it online, sends their documents in, and they get a pre-approval. That leaves the opportunity for what I mentioned before, is that something could come up later. Why? Because we didn't have a conversation with the borrower. And if you did have a conversation, did you review everything that came in? You want to look at all the documents. Let me give you an example. If all you're doing is just sending in documents and they're saying, okay, this is fine, well, now the problem comes in when you look at it. Did somebody actually put their eyeballs on the pay stub? Because in the pay stub, sometimes there are deductions such as child support or a government garnishment of some kind. Unless a lender puts their eyeballs on that document and sees that, all they're doing is saying, oh, you said that you make $6,000 a month, your pay stub says $6,000, we're all happy. That is a lender mistake, and that's why sometimes it comes up later, because the originator didn't take the time to look at it. You went and wrote a contract based on what they said, and now the loan goes into processing, and maybe the processor catches it, hopefully. If not, then certainly the underwriter will. Now all of a sudden you're 2-3 weeks into the process, and guess what? Now you find out there's a problem. So it's important that at the pre-approval stage, that somebody at the lender has actually spoken to the borrower, put their eyeballs on the documents, and make sure they look at it. Another document that you want to have, besides income documents, you want to get at least an asset statement so you can see that they do have the money, and if they don't, where is the money coming from? A conversation. You know, it's amazing how many people today are getting gift funds, which is perfect. Nothing wrong with that. But there are very specific ways that gift funds must be given to reduce any potential problems. If the lender at the time of pre-approval is not speaking with the borrower about how to do it, guess what? The borrower is going to screw it up. Not because they intend to, because they don't know any better. They're not in lending. So there's a lot of things that can happen up front. But you got to put your eyeballs on it. Now, Jay and I had a situation that was for me a little bit embarrassing, but nothing I could have done about it any different. So what I do with the borrower, at the time of pre-approval, when their credit report comes in and they send me their initial documents, my assistant Courtney does a whole review of it. And then I look at it and I do a review, and as I'm working on my review, I pick up the phone and call the customer. And we go through everything. I go through their income, first thing I do is go through their credit report with them, then I go through their income. You know, I actually have the pay stub up in front of me on a computer, and I'm looking at it to make sure there's nothing weird on it, make sure the information that they think they're making, that I think they're making, jives and matches. So we try to reduce any potential problems. And one of the things I do is when I look at the credit report, I go over with people what shows up on their credit report, and I got this little script I use. I've been using it for many, many years, and I just say to them, I just want to go through the credit report, make sure that everything on here is what you are expecting, because sometimes the credit reports are wrong, just like that. Then I go through it. Now, every time I do that, if there is something that's on there that shouldn't be, or something that's not on there that should be, somebody says something. Jay and I had a customer, I went through the pre-approval, did all that stuff. We're 2 weeks into the process. I think 2 weeks and 2 days or something into the process. And one of the things we had to get was a new asset statement. We had to get an updated bank statement because she took money out of her 401k, which is perfectly okay to do, and she put it into her account, so she did exactly what we said. And then we said, now we got to look at that, we got to show the statement coming in. She sent us the April statement. This was last week, Monday. There is a $700 payment of some kind on that statement. Not exactly sure what it was. So we called up this client is wonderful. I'm sure she was not, there's no way she could do anything intentionally wrong. She's just too sweet. Wouldn't you agree? The $700 car was a car payment. She bought a car in February. And I'm like, it doesn't show up on the credit report. The loan is from Wells Fargo. But it does not show up on the credit report all the way through last week. It still did not show on the credit report. So we're trying to figure out what it is. She tells us it's a car. I don't know why Wells Fargo didn't report it, but the very fact that it's now on that bank statement, and that's where the Fidelity money went, we have no choice. That's got to go to underwriting. That killed the deal. Now, why, when I went over her credit report, she did not tell me? Because I actually go through all the line items that, well, there should be a car on there because there's no car. I don't know why. I think it's just that she's too sweet to think about it and just didn't know. And, but that can happen. Now, that seldom ever happens with me, but it did. And, you know, as frustrating as it was, I'm sure for our beautiful customer and for Jay and for the listing agent, it happened. Fortunately, we are still inside our financing contingency. Only because
she didn't follow instructions on receiving a gift.
That's right.
After he told her, I told her, she had her brother wire the gift funds to her. The gift funds for everybody, they go to the
to the attorney. Closing attorney.
She got to tell the lender too.
That's right.
So she received it, and it was from a Vietnamese bank account. So it had to be translated to English. So we extended the financing contingency to get the statement, or she would have been outside of financing.
That's right. So I mean, it's just, there's all kinds of things like this that are weird that can just happen. They pop up. We don't even, but now that seldom ever happens. I mean, that's a really weird situation. But what does happen is at the time of pre-approval, the lender is not going through the loan with the borrower in detail. And if you're wondering why that happens, originators are salespeople. And salespeople want to get through this as fast as they can so they can go on to the next one, as opposed to stopping, going through it in detail with the borrower, making sure you got all your I's dotted, all your T's crossed, so that when I tell you you're pre-approved, that you can with confidence go out, write a contract, and then go to closing. That's why those things happen. And I can, you know, you've heard me say this over and over again. It's very important that you, as the real estate trusted advisor, press your borrowers to make absolutely sure that they are confident with their brother's friend who's a lender, because if that person doesn't do their job, then it's going to lead you to a potential problem. And that's, whether it's me or it's somebody else that you trust, make sure they're doing their front end due diligence. Because if they do the front end due diligence, you're probably not going to have a problem. Now, you may not end up doing a deal because, you know, the person doesn't qualify yet. And but then you're not wasting your time. And that is equally as important, so you can go out and get the next one. And the last thing I'll mention, because it came up twice last week, people continue to ask me, Greg, if somebody does not have credit scores that meet the requirements to get a loan today, will I help them improve their credit scores? And the answer is absolutely yes. I will work up a plan for them that helps move them forward. Now, it might take 6 months, 18 months, it could be any time, but we will do that. We'll put them on a little plan, work it out, tell them what they've got to do. Many times they don't do it, but will we try to help them? Yes, we will. All right, one last quick one. Nicole sent me a sweet client this last weekend, and this lady had very high hopes on what she could do and what she wanted to do. That's where the phone call, not just going online and filling out an application and sending in documents. I had the phone call with the lady on Saturday, sweet lady, and her ideal payment was going to be somewhere between $1,600 and $1,800 a month. That was going to be her ideal payment. She wanted to buy up to $375 and put minimum down payment. Those two don't equate. When I told her that her payment would be somewhere around $2,800 to $3,000, she said, "Oh my gosh." I said, "Well, you can get something for $1,600, $1,800, but you're probably going to be a loan of somewhere between $190 to $220 in there, depending on taxes and insurance." She said, "Well, there's nothing in the market on that." I said, "Well, you're right. There isn't right now, at least not what she wants to buy." So again, it's not just going in and filling out something online. It's a conversation. And if the lender is not willing to have a conversation with your borrower in depth, in detail, and understand their needs and their goals, then it's just they're spinning their wheels, wasting your time, and that'll lead you to problems when they find out that they can't afford to buy the house, or the house is much more expensive than they thought. All right, any questions? All right, thanks everybody, appreciate it.